Banking crises follow a mathematical cycle. It is precise, it is rhythmic, and it is terrifyingly predictable. 1345, 1763, 1825, 1929, 2008. The pattern says the next one hits between 2025 and 2030. This pattern has destroyed 5 global superpowers in the last 700 years. It has wiped out dynastic wealth, toppled monarchies, and redrawn the maps of continents. And right now, in the middle of this decade, the global financial system is following that exact same pattern, stage by stage, decision by decision, almost like we're reading from the same script that led to total collapse every single time before. Most people look at the stock market today, or the housing market, and they see chaos. They see random fluctuations. They see the unprecedented. But if you overlay the data from Florence in the 14th century or London in the 19th century, you don't see chaos. You see a schedule. We have completed 5 of the 6 stages of the Great Banking Cycle. The 2008 crash was not the end of the cycle. It was merely a tremor. It was the warning shot. The math suggests that the structural pressures building in the shadow banking system, the sovereign debt markets, and the commercial real estate sector are aligning for a synchronization event that we haven't seen since the Great Depression. This is the story of how the banking system fails, why they always think they're different, and why the math says we are walking blindfolded into the final phase. To understand where we are, we have to go back to the original blueprint. We have to go to Florence, Italy. The year is 1345. This is the clearest example of the cycle because it was the first time the world saw too big to fail actually fail. Florence wasn't just a city, it was the financial capital of the known world. At the center of this empire were 2 banking families, the Bardi and the Peruzzi. These weren't just lenders, they were the Goldman Sachs and JP Morgan of the Middle Ages combined. At their peak power, the scale of their operation was staggering. The Peruzzi Bank had 15 branches stretching from London to Cyprus. They had capitalized assets of 100,000 gold florins, an astronomical sum in an era when a skilled laborer earned 20 florins a year. The Bardi were even larger, with assets exceeding 130,000 florins. Between them, they controlled the flow of grain, wool, and cloth across Europe. They held the deposits of popes and kings.
Here is stage 1 of the pattern, the innovation of credit. The Florentines invented the letter of exchange and double-entry bookkeeping. This allowed them to create money out of thin air, leveraging their gold reserves by a factor of 10 to 1. It worked beautifully. It created a golden age. Then came stage 2, the yield chase. The domestic market in Florence was saturated. To keep growing, to keep paying returns to their depositors, the Bardi and Peruzzi had to find riskier borrowers who would pay higher interest. They looked north, to England. King Edward III needed money to fight the 100 Years' War against France. He was a high-risk borrower with a history of stiffing creditors, but the yield was high. The Bardi and Peruzzi lent him everything. The Bardi exposure to Edward III hit 900,000 gold florins. The Peruzzi lent another 600,000. To put that in perspective, the total value of all land and property in the city of Florence was less than the amount they lent to one man. Stage 3, the trigger. In January 1345, the war wasn't going well. Edward III simply defaulted. He told the bankers he wouldn't pay. The collapse was instantaneous. It didn't take years. It took weeks. The Bardi and Peruzzi didn't have the liquidity to cover their depositors. Stage 4, the insolvency cascade. When the news hit the Rialto, panic set in. Depositors rushed the banks. The Bardi and Peruzzi suspended payments. They declared bankruptcy. The fallout was total. The entire Florentine economy evaporated. The credit contraction was so severe that trade stopped. Grain shipments halted. Famine set in.
And because the population was malnourished and the sanitation infrastructure collapsed along with the funding, when the Black Death arrived 3 years later in 1348, it wiped out 60% of the population. Florence never regained its status as the singular financial center of Europe. The money moved to Antwerp, then Amsterdam. Fast forward 4 centuries to Amsterdam, 1763. The location changes, but the math remains exactly the same. By the mid-18th century, Amsterdam was the undisputed master of global capital. The Dutch guilder was the world reserve currency. The Bank of Amsterdam was the rock of Europe. But beneath the surface of this stability, a new banking house, Gebroeders den Neufwiele, had initiated stage 1 again: financial innovation. They created a system called wisselrijderie, literally bill writing.
It was a primitive form of what we call today repo markets or shadow banking. They would issue a bill of exchange to a partner in Hamburg who would issue one back. They would discount these bills for cash, using the credit to buy commodities like sugar, coffee, and grain. They were printing credit based on nothing but the expectation of rising prices. Stage 2, the bubble. The 7 Years' War created massive demand for commodities. Prices were skyrocketing. The de Neufville brothers leveraged themselves to the hilt. At their peak, they were handling transactions worth millions of guilders with almost zero tangible capital reserves. They were the engine of a massive speculative bubble across Northern Europe. Then, stage 3, the trigger. The war ended in 1763. The peace treaty was signed. Military demand for grain and goods collapsed. Commodity prices crashed by 30% in a month. The de Neufville brothers were insolvent instantly, but they tried to hide it. They kept issuing bills, trying to borrow new money to pay old debts. It worked for about 5 months. Then, on July 25, 1763, they suspended payment. Stage 4, the freeze. The contagion was faster than news could travel. Because the de Neufville bills were held by banks in Hamburg, Berlin, and Stockholm, those banks suddenly realized their assets were worthless. 95% of the merchant bankers in Hamburg failed. In Amsterdam, credit froze completely. No one would lend a single guilder to anyone. The solid Bank of Amsterdam had to shut its windows. The crash of 1763 proved that you don't need a king to default to destroy a system. You just need a leverage unwind. The Dutch financial supremacy began its long, slow death that year, eventually ceding the crown to London. Which brings us to London, 1825. This is the first modern crisis. It looks almost exactly like 2008. Britain had won the Napoleonic Wars. They were the masters of the universe. The Bank of England was awash in gold. Stage 1, the expansion. To stimulate the economy after the war, the government lowered interest rates and expanded the money supply. Consols, government bonds, yielded so little that investors got bored. They wanted more. Stage 2, the mania. Investors turned to the emerging markets of South America. This was the crypto of 1825. Newly independent nations like Mexico, Peru, and Colombia were selling bonds in London. The hype was unbelievable.
A man named Gregor MacGregor even floated a bond for a country called Poyet. The only problem? Poyet didn't exist. It was a patch of swamp in Honduras. But London bankers were so desperate for yield, they bought 200,000 pounds of Poyet bonds, equivalent to 20 million pounds today. At the peak of the mania in 1824, share prices of mining companies rose by 1,000%. The leverage was massive. Country banks across England were printing their own banknotes to fund these purchases. Stage 3, the turn. In late 1825, the Bank of England saw its gold reserves draining away to pay for these foreign investments. Reserves fell from 12 million pounds to under 1 million pounds. They panicked and hiked interest rates. Stage 4, the crash. The liquidity shock shattered the market. In December 1825, a panic swept the city of London. Banks failed by the dozen. 73 banks collapsed in a month. The Bank of England was hours away from suspending cash payments, which would have meant the collapse of the British pound. They were saved only by discovering a forgotten chest of £1 notes in the basement that they frantically issued to stop the run. The Panic of 1825 established the rule that we still live by. In a crisis, The central bank must be the lender of last resort. But the damage was done. Thousands were ruined. The cycle had claimed another victim. So what is the pattern? When you strip away the costumes and the technology, the mechanism is mathematically consistent. It operates in 6 distinct stages. Stage 1 is the new mechanism. A new financial tool is invented to expand credit beyond the limits of real money. In 1345, it was the letter of exchange. In 1763, it was acceptance bills. In 2008, it was mortgage-backed securities. This innovation always feels like genius at first. Stage 2 is the yield chase. Safe assets stop paying enough interest. Capital is forced to move into riskier assets to maintain returns. This creates an asset bubble. The price of the asset disconnects from reality. Stage 3 is maximum leverage. Everyone piles in. Debt levels rise to unsustainable multiples of GDP. The system becomes fragile because everyone is betting on the same thing, using borrowed money. Stage 4 is the trigger event. A specific external shock reveals that the assets are mispriced. A war ends. A king defaults. Interest rates rise. Stage 5 is the liquidity lock. Trust evaporates. Banks stop lending to each other.
Solvency doesn't matter anymore. Only cash matters, and there is never enough cash. Stage 6 is the systemic reset. The old rules are torn up. Currency devalues. Wealth transfers from creditors to debtors, or it vanishes entirely. Now, look at where we are today. Look at the timeline. 1929 was the start of the Great Depression. 80 years later, we had 2008. The cycles are tightening. The math says we are deep inside the pattern right now. Let's apply the framework to the 2020s. Stage 1, the new mechanism. Check. Since 2008 and accelerated in 2020, we have seen quantitative easing on a scale that makes the Florentine bankers look like children. Central banks invented a way to monetize sovereign debt without technically defaulting. We also saw the rise of the everything bubble mechanism, zero-day options, algorithmic high-frequency trading, and crypto leverage. Stage 2, the yield chase. Check. For a decade, interest rates were zero. You couldn't make money saving. So trillions of dollars flowed into tech stocks, real estate, and speculative assets. The Magnificent Seven stocks holding up the entire S&P 500 is the definition of a crowded trade. We have seen sovereign wealth funds chasing yield in private credit, exactly like the Dutch bankers chasing sugar futures. Stage 3, maximum leverage. Check. Global debt is now over $315 trillion. That is 333.
Banks are holding assets on their books at 2021 prices, hoping rates come down before they have to mark them to market. But the pattern says they won't make it. The future projection is clear. The next stage is the liquidity lock. It likely starts in the shadow banking sector, private credit, or the repo markets, just like in Amsterdam, 1763. As the refinancing wall hits in 2025 and 2026, corporations that survived on cheap debt will face insolvency. When this happens, the central banks will face a choice that the Bank of England didn't have to face in 1825. In 1825, money was gold. Today, money is fiat. The pattern dictates that when the next liquidity freeze hits, projected between late 2025 and 2028, the central banks will be forced to print money on a scale that dwarfs 2020. They cannot let the sovereign debt markets fail. They cannot let the US Treasury market freeze. This leads to stage 6, the systemic reset. In 1345, the reset was a default and a plague. In 1929, it was a depression and a world war. In the late 2020s, the reset will likely be the devaluation of currency itself. The solution to the debt crisis will be to inflate it away. This is why we see central banks globally rushing to develop central bank digital currencies, CBDCs. They are preparing the infrastructure for the reset. The skeptics will say, this time is different. We have AI. We have better regulations. The Fed knows what it's doing. This is the exceptionalism trap. The Bardi thought they were different because they had the Pope's money. The Dutch thought they were different because they controlled the trade routes. The Victorians thought they were different because they had the steam engine. Technology changes. Human nature does not. Math does not. The pattern of credit expansion and contraction is as natural as inhaling and exhaling. You cannot inhale forever. Eventually, you have to exhale. The world has been inhaling credit for 40 years, since the start of the current debt supercycle in the early 1980s. The lungs are full. The pressure is critical. 3 times it happened before in exact sequence. 3 times the world changed overnight. The pattern says we are next. Maybe we have 2 years. Maybe we have 5. But when the yield curve uninverts, when the unemployment rate ticks up past a critical threshold, the slide into stage 5 will be rapid. It doesn't decline gracefully. It collapses quickly, brutally, and without mercy.
The only way to survive the pattern is to see it before it completes. While the world is distracted by political theater and daily stock ticks, the tectonic plates of the global banking system are grinding toward a rupture. 1345, 1763, 1825, 1929, 2008. The date is set. The math is locked in. The only variable left is you. Will you be the one holding the bag when the window closes, or will you be watching from the sidelines, understanding exactly why it had to happen?